We'll see.
Sunscreen on, the hat, dark from shade to shade. And even then,
Afternoon, everybody. I was told that at 2 o'clock this starts rolling, so whoever's logged in can listen in and watch from their remote location. So, again, afternoon, happy summer. Hope everybody's having a decent summer. Hope we had some time to take some PTO or, I don't know, whatever we do to go on vacation, if there is any, with what's happened in the past couple of months. We usually start with our updates on just went on during, I guess, busy season, or just updates for the individual trust. And so I'm not sure of how it's here. Oh, there he is. So.
Or we can start now.
So I guess we could start with the individual update if Nicole wants to
Really quick.
comment on a couple things.
A couple things, nothing major. The applicable federal rates for August have been published, nothing crazy going on here. The short-term and midterm went up very slightly, long-term went down slightly. Again, nothing crazy. I don't know how many of you have seen the draft postcard, if you will, of the new 1040. They say it's less than one page, and I say that very loosely just because it's basically things have just been shifted around.
It's $10.
Supposedly. Well, yeah, so you're going to talk about it in detail, but this is our new, supposedly 1040. The 1040A to 1040 Easy have been, they're no longer around. But what's interesting is I say, the quote, it's very loosely because it's 23 lines, 50 lines less than a 2017 Form 1040, but there are 6 new schedules. So, yeah, let's cut it all down to a postcard, but let's add 6 new schedules, which basically that's where all those lines were transferred to. Schedule 1 is for additional sources of income that are non-W-2 related. Schedule number 2 is other forms of tax, i.e. children's unearned income tax. Just as an example, Schedule 3 is your non-refundable tax credit. So again, things have just been shifted to these schedules now. Schedule 4, certain other taxes. They're basically added up. So your SE tax, your Medicare tax, there's basically a schedule for the schedule. The Schedule 5 is all your tax payments that are added up. So basically, page 2, bottom section is now just its own schedule. So and Schedule 6 if you want to appoint a third-party designee. So really, the tax return, the 2 pages were chopped up and basically just shifted to these new schedules. So again, I say it's a draft form. Obviously, nothing has been finalized yet. There's also several other lines, obviously, for the QBI deduction. And I had mentioned before the 1040 Easy and the 1040A are now gone. So it'll be interesting to see what actually comes of these schedules and this postcard, if you will, but
Don't forget page 2, line 9 and 10 are very important.
say no longer.
They haven't been defined yet, but they're very important. That's $199, can't they?
Well, yeah, there's like I said, there's going to be many new lines, but they haven't even defined them yet.
And you have to put the excess, if you have more than 2 kids, you have to put them on another schedule.
Probably.
Yeah.
I wouldn't be surprised.
Yeah.
Another schedule to the
Yeah.
schedule.
And then which kids go online on the front page and which kids go on the
The
back?
back page?
Yeah.
I don't even want to think about it yet. Tax season's gonna be fun. Moving along, there's a veterans and disability severance payments for after January 17th, 1991. If these should not have been included as income on the taxpayer's return, and obviously, we have a statute that limits the refund period, but there is an extended refund claim period. It does apply. They estimate 13,000 and change veterans have had excess tax withheld from this income, and the estimated income amounts to approximately $78 million. So that is a potential, go back and amend for the veterans. Amended tax return, prepared due diligence. The IRS anticipates revising the Form 8867 to include a head of household filing status for the 2019 filing season. Again, it's just a prepared due diligence checklist. And this isn't really individual. I don't know where it kind of fits, but I figured I'd mention it just because it's kind of random. The IRS has removed donor disclosure requirements to some tax-exempt organizations. Obviously, if you contribute more than $5,000 to an organization, you still have to disclose the information, but they did kind of remove some of these requirements. So that's all I have. And any questions, comments, concerns?
Yeah, I have a few things to add to.
I figured you
you
would.
were- yeah.
I said you had that. I figured you were talking about that. So
To add to our misery,
it's not misery. It's fun.
how many people do returns for people in New York City?
The new stuff.
Oh, you're gonna love this. Thanks to Mike.
Oh, of course.
You now have to post your price list in a place where everybody can see it, telling them how much you charge to do the tax return.
And that's being 14-point font, I believe.
They tell
different
you the
languages,
size,
Different languages too.
and you gotta have a couple of languages in case you, okay, those doing it in Hebrew, just let us know. We'll see what we can do. The penalties for the first violation start at $375. And they go up to $750.
No. No, de Blasio.
And in addition to English, all disclosures required by this section must be made in English and in any other language that the tax preparer uses to attract customers. So if you press 8 for Spanish, is that what it is on the, and when you call Verizon, they tell you to call AOL, all kinds of numbers.
Aprende numero dos.
Okay, so, that's what you gotta look forward to in New York.
If you have any clients in New York,
New Jersey,
that's New York, New York City, excuse me, New York City.
if you have clients who receive, and you use Drake, by the way, and you have clients that receive distributions, RMDs, you put amounts on line 19A and 19B, you have to be careful what was put on line 27A. They are sending out notices because Drake was using the wrong numbers, and they're going to correct it for 18, but they're not going to go back and correct it for 17. So just be on the lookout. The client may come in to you with a notice from the state of New Jersey assessing a tax because the line was incorrect. But that's the line. 27A is the line for pension exclusion.
Somebody must be calling.
My mother-in-law.
Must be
Okay.
de Blasio.
It's the commissioner.
Must be de Blasio on the
She's
street like in New
deceased,
York City.
writing me from the.
Is there a minimum requirement for New York City? For disclosing your prices? What if you do two city residents?
What about it?
Do you have to disclose your prices to the city of New York?
You don't have to disclose it to the city of New York, it's supposed to be posted,
In what, in your office?
yes.
They come to visit?
It's set up for, you know, the top shops.
Right.
Okay, so, yeah, we're not thoughtful enough to exempt CPAs,
Right.
okay? So, we are lumped in with, you know, the
other tax
top
preparers.
shops.
Right.
Only if you have a New York City office, or?
No, if
Come
you
out
do
to
New York, if you have New York City clients.
New York City. This is a New York City law.
So New York City has the manpower to go around to all the states and check CPA firms.
Well, they're gonna borrow some people from the IRS.
No, if you go in through the Port Authority, they're going to,
Check you at the bus.
You're gonna have a building there.
I have a dry cleaner next to me
The
with
New
a swap sign.
Jersey, the New Jersey amnesty has not started yet. Okay, the starting date has not been posted. So just be aware that it's going to cover from December. It's going to be for 6 months. February 1st, 2009 to January 1st, 2018. Okay, so the dates have not been secured yet, and it'll be for a 60 or a 90-day period. That hasn't been described yet. Okay, this is the Assembly bill. and this was sent to me by the state, but it hasn't started yet. It was supposed to start July 1st, it hasn't started yet. The other thing to be aware of is, of course, there's new scams. How many people have clients that have passports and haven't paid $50,000 in taxes? 362,000 people will find that they can't travel. Okay, so that's coming out.
And wasn't there a woman in Glen Rock who just,
The woman got scammed.
for 20 grand?
Yeah. She didn't attend my course that I gave at Glen Rock. That's the problem. Every day, Bloomberg Tax and all the other purveyors of CPE are telling you to come to their courses on 199 Cap A. I have spoken with Tony Needy and a few other people, and everybody's on hold. Okay, and you're not going to learn any. I mean, if you haven't gone to one, then you should be ashamed of yourself. But if you've gone to one, you don't have to go to the others. There is nothing new. There is, suppose we do this, which is not concrete and not an answer to our questions. My only suggestion that I got from all of this is your clients are going to be under withheld for the most part. Because they're number one, they're going to lose the real estate taxes. I don't care who's suing who. They're going to lose the real estate taxes. And unless they make large charitable contributions, they're not going to, they may not be able to itemize. You have heavy hitters, and you have others in your office that their income fluctuates. Somewhere between now and December 31st, you should sit down with these clients and explain you may not be getting a refund, you may have to pay additional withholding taxes or estimated taxes. The next one is September 15th. So my suggestion is look through your returns, because you know who's going to get blamed.
You are.
We are, no matter what. So seriously, this is the way. You know, you don't want to charge. This is you got to make a living, and people have to know that they're going to pay next year. I had a client that had to make a bulk sale payment of $217,000 to the state of New Jersey in order to sell the property. She can only write off 10. I don't relish the thought of sitting with that person and telling that we lost $206,000. So it's not going to be fun. But I'd rather do it now than do it in April when they get their return done and the surprise is there. Look, you owe money. The penalties will be many. Chances are we're going to get forgiveness of penalties due to the continuing changes in W-4. I'm sure that everybody has seen 3 W-4s already. So just keep that in mind when talking to your clients. If anybody wants to read up on qualified business income, I have 98 pages here.
It's just been repealed.
That's Google telling me my name is no good. So, if you have any questions or any problems, just let me know. But these are the things that are hitting the fan right now. Thank you.
Thank you, Howard. Thank you, Nicole. So, as you know, there are many changes, so as we get more updates, we'll post whatever, but I know there's always a lot of questions and going back and forth, but there's always also answers and people's opinions and thoughts, which is very helpful to the group. So for this, usually for when we do an international portion, we try to pick a topic, but I felt this year was it was important to at least just show the updates of what happened with tax reform, or highlight the important ones, I should say, or the ones that we're probably all going to be more exposed to. So we put this presentation together. As you know, my name is Bayan, and this is Chip. Chip, you want to introduce?
Yes, my name is Chip Nicolay. I am a director with Eisner Amper. I deal with strictly international tax. My background is, unlike everybody here, I went to law school. So
So you're a consummate lawyer.
no, I don't take positions. I'm very conservative in my positions. But no, on a more serious note, I went to the Big Four out of law school, and then made manager at PwC, International Tax Core Group. About 4 years and change ago, I went to a regional or national, smaller size national firm named Baker Tilly. I was in a national group there. And what do I do exactly? I basically do the tax structuring from international tax perspective, so it's not only US tax I have to get a grasp of, it's also the international rules I have to look at. And back before 2018, or January 1st, 2018, what we did was we tried to see if there was any, let's say, loopholes between the foreign tax rules compared to US tax rules, and try to find some sort of tax planning opportunity for our clients. I've dealt predominantly in the corporate realm, so the 300 section of the code, and the 900s, obviously. And I also have to be tax technical from an international tax perspective in order to determine positions and the likes. I do review forms, specifically 5471s, 8865s, 8858s, and 926, as you will discuss. And let's see, specifically wanted to mention that there's going to be a lot of change still. Right. I mean, we only got a very brief, let's say, taste of what international tax reform was at the beginning of this year, end of last year. Right now, everybody's in the marketplace going out and basically they're trying to take positions or trying to basically teach or discuss tax reform, but it's very minimal. The meat on the bone will come when the interpretations come or the guidance comes from the IRS and Treasury Department. I anticipate that, and the information I have is that Treasury will be putting out stuff on GILTI piecemeal in September and October. There could be a 2-month lag on that. And also they will be also tackling BEAT, base erosion, and anti-avoidance tax, and what they will also in hybrid instruments. I've dealt, because I've worked with corporations and on multinational transactions, I have a soft spot for hybrid instruments and hybrid entities, especially since we do a lot of check the box, right? And there's a lot of question what will happen, because what was originally discussed a couple of years ago during, let's say, tax reform as was envisioned by David Camp at the time, was somewhat different from what actually came to be. So I followed tax reform, even the rules as they were adopted later on, it's slightly different. But I'm sorry for taking up. I will introduce a little bit with Bayan. He's the main guy. He drafted his presentation, so I'm here to just assist him, and I'm glad to be in front of you.
So thanks, Chip. He has a wealth of knowledge, as he just highlighted too. So please, this could be an open discussion, or I'm sure there'll be a lot of questions. So feel free to pop them as we go along.
And one thing is, I'm sorry, I'll be looking on my phone specifically because I understand we're virtual and there's going to be questions coming in. Instead of having a laptop open in front of everybody, I'll be receiving the questions on my phone and trying to relay. Okay, so don't mean to be rude.
So the agenda. We're not sure how much we'll get through, but we'll try to get through everything. We'll try to get through as much as we can. First up, we'll start with Section 965, the mandatory deemed repatriation. Probably spend a little bit of time on that and possibly explain an example, sort of, just to get the high level of what it's about. Foreign tax credit, what you need to know. International forms, so Form 5471s, Form 5472s, 926s, and the GILTI, brief explanation issues, and FDII. So I think the hot ones would be GILTI and the 965, but like I said, as we go along, we'll any questions could start a discussion or some sort. So.
And what I could chip in there on from a 965 perspective, I remember when it first came out, everybody was rushing to have some sort of news alert and doing circles saying, wow, there's going to be a tsunami of work coming in strictly because we have tax reform from an international perspective. Now, what happened was, there's tax reform didn't necessarily, let's say, affect everybody. And in the corporate realm, you have C corps that are obviously going to be affected by tax reform, but you have S corporations. S corporations had the opportunity, and being in the middle market now, you come across a lot more clients that are S corporations. So a lot of these S corporations now have the option to basically not. They have to calculate the 965 repat tax, but they could push down the liability at a later road when the event's triggered, and we'll discuss that.
Yep.
So what I'm trying to get at the end of the day is that tax reform really didn't, I feel tax reform didn't really create, let's say, the tidal wave that everybody was expecting when tax reform was adopted. Specifically here, I'm referring to S corporations and other entities that are not necessarily affected by this immediately.
And I think also I don't want to say the biggest surprise, but a surprise was that it affected a decent amount of individuals that didn't think they would be affected. And I think that's like the confusion of, they were like, okay, this 965 is just a corp thing, and then as you read the instructions, and I'm sure they made a mistake trying to write it because they were definitely aiming more for corporations, but it encompassed individuals too, trusts, so it kind of reeled them in, and now we have clients that are, have smaller entities, smaller CFCs, and they're like, all of a sudden, like, I don't have any money in these. Why do I have anything to do with this? So it definitely hurt in that sense with our individual clients, I would say. So, I guess a quick poll question: has anyone dealt with 965 this season?
I put them on extension.
Did New Jersey clarify anything on this yet,
965 so far, it's just been on corps and individuals. I believe the budget that just came out with corporations, they get the exemption.
I'm sorry, I don't handle
Okay.
this.
So that's
They just came out with a definition
yeah.
of 965, because I think it had to be pre-tax money or something. You can't just
Exactly,
you can't
yeah.
just take today's transaction
Yeah.
and make it a 965.
Yeah. Exactly.
It had to go through a mill somewhere.
So do you anticipate you will be affected by your clients will be affected by 965?
Probably in 18.
And 18.
In 18. Okay. And the one thing that I'm noticing is now, like I said, there was a little bit of rush when the law was adopted, but what happened was immediately after, people realized that if they have S corps, they could go on extensions. They don't have to calculate the EMP at the moment right there, and they could punt that until after extension if there was no liability on it with, let's say, other individuals and
Yeah.
firms and likes.
So I know what happened when come extension time. I had a lot of clients who have S corps, so we weren't really worried about the federal because there wasn't any payment due in April. But for some of these states, I know Oregon was one of them. Somebody can correct me if I'm wrong, but with the 965, and we'll go over that, you get something called the participation exemption. And some states where you don't get that, so you start with the gross, and that's the tax. So, but I think as it came out more and more states where it's the net. But what also hurt though, a lot of these states, they didn't recognize installment payments like federal was. So that means clients had to pony up, and we had some clients who had to go to the bank and borrow money to pay some of these taxes, because I don't think there was a single state that actually gave the option to pay in installments. It was you either pay the whole thing or you're paying on the gross. So it wasn't good news to try to explain that to clients, especially the ones with S corps. They're like, that doesn't make any sense. I don't owe anything for federal. Why do I owe something for state? So it was definitely long conversations trying to paint that picture and illustrate that.
And a little footnote with your statement on participation exemption, which we will discuss a little bit later. I think the most important issue that should have been tackled probably prior to April 15th or March
Yeah.
15th, was trying to determine whether an S Corp should convert to a C Corp, right?
Yes.
In order to take advantage, or for an individual to take a 960, make it to 962 election in order to take advantage, in this case, of participation exemption. Not necessarily like to the
Yeah.
individual, but to take advantage of the participation exemption,
Yeah.
which allows, in effect, dividends to come up from a foreign subsidiary up into the U.S. tax-free. We'll discuss that.
Yeah. So it was we could say it's unfair because we had such little time and clients had to dish out so much money for something that wasn't exact and there wasn't, definitive guidance. So as you know, Section 965 existed before tax reform, but it was more geared towards C Corps. It allowed C Corps to elect to distribute earnings and pay 5.25% on U.S. federal income tax, as long as they had a DRIP, a dividend reinvestment plan. So what the new 965, it was a broader scope. It's no longer just corps, and it applies to any U.S. shareholder, and you hear these terms of a deferred foreign income corporation. Right? So before 965, we didn't really care about. Now the new 965, pretty much everybody at least has to take a look at it and see if it affects somebody that they provide compliance to. So summary of the 965, we figure we'd put a summary and then we'd go into detail. So all U.S. persons, and the emphasis on all, and like we highlighted in the beginning, the first thought was it was mainly corporations, but it was all U.S. persons, right? So corporations, S corps, partnerships, trusts, individuals owning 10% or more of a CFC, a controlled foreign corp, they must pay a mandatory tax on their earnings and profits held by the CFC. So when we say earnings and profits, of course, they're to calculate tax earnings and profits, there are adjustments. It's not just you take retained earnings and call it a day and then pay the tax, but that's a good starting point, especially with getting together the EMP. You have to go back years and years and years and years, and the common response we've got from clients is we don't have that information, and at the end of the day, we're at the mercy of the clients. There's not much we could do if they tell us they only have financial statements going back through last 7 years or something like that. So
the technical term I think we're looking for is accumulated earnings and
Yeah.
profits, and it's post 1986 EMP. And you are right, though. A lot of times you do find some of these big clients that either have a very pristine environment and all the information is available, or that information, because there's been serious acquisitions and the likes, that information is not readily available and you have to rely on the representations.
So historically, when you file the Form 5471s, there's something called the Schedule J, and this shows all the adjustments it pretty much shows the activity that happens with the CFC, just to keep it high level. Generally, just from talking to other firms and other professionals, I think the common ground is these 5471s haven't been prepared to the utmost of, I guess you'd say, compliance. So
I'd beg to differ.
It doesn't do any good anymore.
There's one exception in this room.
And the big reason for that is the lack thereof of information. So you're bound to whatever they have. They give you, here's an Excel schedule of our CFC. That's what we're using. So, but now that this came out, this kind of, I would say, scared clients. So all of a sudden, there's more information than the previous year. So we were using that to calculate the accumulated earnings and profits.
There is, however, there's two things you have to keep in mind. One, you do have to file 5471 if you have a CFC, otherwise there's a penalty, right?
Yeah.
And a $10,000 penalty per form. And then the other thing you also have to make an effort to have to report the information correctly.
Exactly. Yep. So that's where record keeping, as we all know, is very
All
important.
clients keep great records.
What records?
I'm not
It's in the
hearing
cloud.
anything.
Yeah. So the rates, I guess Chip will chime in on the act. I guess we're going to go into the technical definitions and terms, but right now this is just high level and say these are the mechanics, these are rates, these are numbers, this is what's happening. So with the rates, it's 15.5% on the EMP attributable to cash, and we'll go over what exactly that means, and 8% on the remaining, so the liquid assets. And the rates are achieved, it's almost backwards, I would say, through the dividend received deduction. So you end up, when we show, I guess, an example of how it's calculated, that's the rate they're paying, and that's where that exemption comes in, that deduction comes in. Okay. So they also allowed a possible you to net your deficit from CFC1 against your EMP of CFC2. So, but it's a mathematical, it's arithmetic, but the way it's netted, it's not just you have negative 10,000 in accumulated earnings and profits, so you net it against something else that has income. It's a little more to that.
It gets complicated, right? And on a very high level, you would have to say that, okay, you have back, so let's say in the mid-market, or let's say the multi-billion-dollar multinationals. In this instance, they have a lot of times foreign holding companies. But what I was a little bit surprised in this instance, because a foreign holding company would allow you to basically take the earnings and profits from one CFC and potentially net them against other CFC. And here you have to literally think virtually, in the sense that the holding company is the US entity that it rolls up into, right? That's the way you have to imagine, because at the end of the day, you're basically taking the EMP deficits from one or a couple of CFC subsidiaries, right? And then netting them against the EMP deficits in other subsidiaries, or specifically CFCs. But what I think you're alluding to is whether if these entities are DFICs or deficit companies, right?
Yeah.
And in that case, it gets a little bit beyond the nuance of this course, but what happens with let's say, let's just say where you have deficit companies. I'm just going to take you, let's sidetrack for a quick second. If you have a deficit, EMP deficit, let's say for a current year, that doesn't necessarily mean that you have you have a deficit company. It has to be a EMP deficit, accumulate EMP deficit over the years, right? And the other thing is, if that EMP deficit company or that CFC has PTI, previously taxed income, then the way the law could be interpreted right now is that PTI could, if the PTI amount is higher than the deficit of that entity, of the CFC, then you could potentially say that, wait a second, you don't have a deficit company because although you have an EMP deficit, your PTI balance is higher, and therefore you could be neither a deferred company or a deficit CFC. So this is where the nuance and this is where the imperfection of the law is, specifically since it was drafted so quickly, whereas a previous tax reform in '86 took probably like 4 years to get done. But, all right.
And we thought this would be a good break for them. They give taxpayers option to pay the tax over an 8-year period. We'll show there's rates. It's not just a straight, take your tax liability and divide it by 8 years. And it's limited foreign tax credit triggered by the deemed repatriation. It would be available to offset the tax. So that also too is limited. And as we all know, the S-Corp's got a big break with this Section 965. They'll be subject upon a triggering event, so whether death of the shareholder or they sell their stock. So there's a list of the triggering events. But
so going back to what we stated earlier, I think one of the most important decisions when this came out was whether the S corporation was going to go to C corp status or punt the problem down the road, although they still have to calculate, all right, what the repat tax would be in case and still report it, and they have to determine or keep track of it, because in case there's a trigger event, as my colleague here mentioned, it would trigger the rule immediately, and it's also bankruptcy, it's also liquidation.
Yes.
And you're right, the sale of stock is the one that really they gear towards.
so we actually had one client who revoked their S election. They actually, went back to being a C corp, So that was a triggering event to the shareholder, so, and they didn't care, but
So yeah,
that was for other reasons.
so when people are looking at this, whether to switch from an S corp to a C corp or from a partnership to a C corp, most people are like, this doesn't affect us. And the thing is, well, if you have international operations, and let's say your international operations amount to over 50% of your revenue, then you really should have given serious consideration to whether you want to convert to a C corp, because the participation exemption regime and also the opportunity to bring back a lot of the money at a lower tax rate, effective tax rate.
I think this is a good note to add. The deemed repatriation rule, it's part of subpart F, so it's before in the year of any actual distributions. So just read it from the slide itself. This means a U.S. shareholder of a CFC with EMP surplus will pay tax under the subpart F and deemed repatriation rules for 2017, not on the actual distributions.
And the one takeaway here, I would say, is when you're doing a repat tax, don't combine it with subpart F. If you've had subpart F income, let's say prior to November 2nd, that's separate, right? You have to calculate the subpart F liability, and then you have to focus on your repat tax from November 2nd and the other measuring date, which is December 31st.
So now we'll get into the code sections, and I'm sure Chip could better speak on this, but we'll go through each one.
Yeah, so we'll go through the slides.
Yeah.
I'll comment on this, and then I'll take you guys very high level through. I want to give you bullet points in your calculations in case you do come across this. Probably should have put something on that board, but I kind of want to just make sure you get a very high level steps of how you should tackle this, because a lot of times, and I've seen it, and various firms do the same thing, they were out there trying to model the law for every kind of possibility and scenario. Not really possible, right? Unless you're gonna really blow budgets and waste the client's money. So, you have to have a template, and you have to work off that template, because every scenario is different in its own way.
So basic rule of 965A, in the case of the last year of the deferred foreign income corporation, which begins before January 1st, 2018, the subpart F of such foreign corporation as otherwise determined under 952 shall be increased by the greater of the accumulated, as Chip mentioned earlier, post-1986 deferred foreign income of the corp at November 2nd, 2017, or December 31st, 2017. So there was a lot of confusion on why the heck they would choose November 2nd, and
Absolutely. So what happened was here, you do have to look at accumulated EMP, and the measurement dates, as mentioned, were November 2nd, 2017, and December 31st, 2017. The reason you had November 2nd was that was around the time that the law was adopted. People were already in the marketplace or thinking, how am I going to do, what are my strategies in order to decrease my EMP, accumulated EMP surplus? So a lot of times, people were considering when they saw the draft of the bill that maybe they were just going to distribute money out or come up with some planning strategy in order to decrease that the earnings and profits. And so that's why you have the two measurement dates there, in case you want to have, the greater of. That's the key word. And I mean that was the reason why they did that. And so when I look at the rule itself, and I start thinking how to model this, there's two key, let's say, concepts in there, right? Before we get to the 15.5 and the 8%, right? The key one is it's the one we mentioned right now. Is what's your accumulated earnings and profits, right? So you take end of 2016 earnings and profits, and then you also add the current year's EMP. And in effect, what you want to do is have two measurement dates, just in case, let's say, there was additional earnings and profits or a decrease in the earnings and profits between November 2nd and December 31st. The other one we will be talking about very shortly is also cash. Cash is, you have measurement dates when it comes to the cash. And so you're going to need to have a good balance sheet in order to determine that. But go ahead, Sam.
so continued deferred foreign income corporation means with respect to any United States shareholder, any specified foreign corp of such U.S. shareholder which has accumulated post-1986 deferred foreign income greater than 0.
So the reason it's deferral is because CFC was part of a deferral regime. And that's the subpart F that we're talking about. And so when I was referring before to defects, this is the exact thing. It was a company that was deferring income, not bringing the income back to the U.S. It was basically offshore and coming up with strategies which would be tax efficient when they wanted to repatriate cash. Does anybody need me to go in more depth about subpart F? Or what was subpart F, the way we knew it? No? Okay. So I think the one other thing we wanted to mention was that the way I would say the first thing you have to do when you calculate, let's have this piecemeal. You take you have to look at the pro rata share of your deferred foreign income, right? And the next step is you also have to look at your pro rata share of your foreign EMP deficit. And this is going across the board, right? Because you have different CFCs. So one might be in an EMP surplus, the other one might be in an EMP deficit. At the end of the day, what you want to make sure you get to is your 965 inclusion amount. So that, you have a couple more steps to go in there, but at the end of the day, that should be your accumulated earnings and profits.
And that alone, in my experience, has been a task in itself, calculating getting to that number, and then you start the calculation.
And so the other thing you want to consider is, let's say, you take the 2016 accumulated EMP and the 1231 or year-end EMP for 2016 for a CFC, and then what you do is, let's say you've had maybe certain distributions that have taken place in Q1, Q2, or Q3. You add those back, and that's a key factor. And then, and also you have to take into account is that if you have multiple CFCs and you do have deficits in other CFCs, from a very high level perspective, you could probably say, okay, I'm going to dollar for dollar this, and combine dollar for dollar and offset them in order to get to my tax liability.
Exactly.
Are there any questions so far? Howard? No? All right.
We're waiting to see where this is going.
Okay. Well, it's going to the tax
I made all my
liability.
foreign clients come here.
Sorry.
Are you seeing anything?
I haven't seen anything yet. No.
So as Chip mentioned, it's determined without regard to actual distributions made during the year 965 applies. Portion of the 1986 EMP subject to the transition tax does not include EMP that were accumulated by the foreign company prior to retaining their specified foreign corp status.
They're still coming out with definitions, from what I understand. They were not clear on the 965.
They're
The CFC and the other one, they were just not clear.
SPCs. SPCs. Yeah. So you're right. There was a little bit. The CFC, you do know you have the 1050 rule, right? I think what they did was they strengthened the rule a bit, which I don't want to jump a little bit, but it will be mentioned later on in the presentation. But the 1050 rule means that you have a minimum U.S. shareholder, one U.S. shareholder that has at least a minimum of 10%. Back in the day was number of shares more than 10% of the voting power and value of the shares of the CFC. And then what happened was, then you also need that the U.S. shareholders combined, right, would have greater than 50% of the ownership of the CFC, right? That's a 1050 rule, traditional one. So in effect, the reason that's put in place, because let's say if you had a bunch of U.S. shareholders that each were unrelated, no attribution rules, 318 not applicable, right? So if you have 9%, 9%, 9%, 9% shareholders, you're not going to have a CFC, because you need a minimum one US shareholder that has a minimum of 10%. And combined, all the US shareholders have to have over 50%. And so the rule has changed a little bit, but we'll talk about that in a second.
So I think last.
And just a little, the other point is, there were people that were getting caught under the CFC rules potentially that were not, in a sense, I think what you're referring to in certain instances, the SPCs, the Reason Act gets brought in, because there are situations where, exactly as mentioned, it's a 1050. You have to look at the 1050 rule. You could potentially have at least 10% US shareholder, but combined the US shareholders don't have over 50%. So under the old rules, the CFC rules didn't apply. Do you understand? So you have 1050, right?
Yeah.
So 10% US shareholder, combined all the US shareholders have 51, greater than 50%. Just assume 51, yeah, greater than 50. But what if you had an instance where you had 10% US shareholder, but it was less than 50%? In that instance, the traditional CFC rules did not apply. Okay? The way it's saying now is that, hold on one second, the SPC rules come and say they apply to this individual that has 10%, or SFC.
Yeah. So specified foreign corp, section 965E, any CFC, so I think this, highlights to what you just commented on. Any CFC and any foreign corporation with respect to which one or more domestic corporations a U.S. shareholder, for purposes of 951 and 961, this latter category of specified foreign corp shall be treated as a CFC for purposes of taking into account subpart F income of such corporation under 965. And PFICs are excluded if they're not CFCs, so that was key. Pro rata share, I think as Chip mentioned, just going over the high level of where you start and how you determine what the U.S. shareholders or U.S. taxpayers' pro rata share of his deemed inclusion. So it's the same as subpart F rules. All specified foreign corps treated as CFCs, and there's a special rule for 965 F2 to treat the dividend received deduction portion of the inclusion.
So, when you look at this rule, the reason at the end of the end result will be a repatriation tax, right? That's the end result. But the way they take you through the modeling of this, the calculation of it, is basically in trying to convert from a deferral system to a participation exemption regime, right? And so that's why when you see DRD really associated with participation exemption is more of a European concept, and it's applied to basically distributions coming from subsidiaries of the parent company. And usually there's a holding period. I think in the US it's a minimum of 1 year. When this rule was drafted, in order to get participation exemption, I think some of the proposals that were out there, they were talking that if the effective tax rate, let's say in the foreign jurisdiction, was lower than the effective tax rate in the US, or we could say 21% at the level of the company, in that instance, participation exemption would not have applied. That's not the case, right? That disappeared in the final bill, or the later proposals. So what you do have is you have a foreign subsidiary, a CFC, distributing to the parent company. So when the dividend distributions come in the US, or the foreign jurisdiction, let's suppose Luxembourg, it's tax-free, meaning it's Luxembourg or the US does not tax it. However, that doesn't mean that, once the US has the dividend distribution, it's received, the US entity received the dividend distribution and decides to distribute to the individual shareholders, then we have a taxable event at the level of the shareholder, right? So we don't forego US tax altogether, but the participation exemption regime, in my opinion, is also meant to allow to repatriate cash back to the US a lot easier, and also circulate cash within the structure if you want to, let's say, use the US as a holding company, which traditionally you didn't do in the past, and deploy the cash to other places around the world in a more tax efficient manner. Any questions? Sorry.
Reduction in income inclusion for specified foreign corporations with deficits in EMP. That's 965B. So a lot of these slides you'll see we mention, the works of it in the previous slide or just in comment. U.S. shareholders may net their EMP deficit of loss CFCs against the post-1986 EMP or profit-making CFCs.
Do you guys understand the hovering deficit rules? Or have come across them? So hovering deficit rules basically means that if a U.S. company goes out, or its let's say its foreign subsidiaries go out and acquire a foreign entity and which will become a CFC, right? Or it was a CFC for another company. If it doesn't make a 338G election, in effect, to wipe out all the tax attributes, then it inherits certain tax attributes that that entity has, or the CFC acquired, let's say target CFC, let's call it for argument's sake here. And so in effect, what you have is, let's assume also that we have losses in that acquired target CFC. What you have is basically a situation where if you have your existing CFCs with a surplus, EMP surplus, is there any tax opportunity to basically offset historic losses against, let's say, historic EMP surplus? And so the way the hovering deficit rule came about was they were trying to prevent that kind of example. So in effect, the old rule stated that basically you could take the hovering deficit that you had, historic deficit, EMP deficit, and use it against any future EMP surplus or current year EMP that entity had, the target entity, going forward, right? Now they're saying, okay, hold on 1 second. You know what? We do have this EMP event here that we have to take into account for repad purposes, but you know what? You can use the historic EMP deficit, which is a good fact, actually, for once.
Application of the participation exemption to included income 965C. U.S. shareholder allowed a deduction against the amount included in gross income. So this is pretty much what we were talking about with you calculate your accumulated EMP, after you go through your calculations with the deficits and all that, you have your income inclusion. 965C gives a participation exemption, and that reduces the 965 inclusion, and then that's how then it's taxed at whatever rate it is. So that's why I said I don't think it works backwards, but that's that 15.5%, and then the 8% for the non-cash. That's where the deduction comes in. So I think we'll go over how that works and how we compute the 15.5 on your cash or cash equivalents, and the 8% on the non-cash. So I think it says U.S. shareholders are allowed a deduction against the amount including gross income under 951A1 by reason of section 965, and an amount at such rate that the U.S. federal tax applicable to such income will equal 15.5% for EMP attributed to its foreign cash, and 8% for the remainder of its EMP. So the above rates, those rates apply to C Corps. With individuals, it ended up being a little higher, 17.5 and 9%. Application of the participation exemption included income. So I guess this is good because it highlights the first steps. You need to prepare a consolidated balance sheet for all your specified foreign corps that the U.S. shareholder has shares in, and you calculated your aggregate foreign cash position. So you keep hearing cash and cash equivalents, so it's not just cash, it's not just the account that has the cash balance of the CFCs. It's cash, net accounts receivable, and we can go into detail on that. Fair market value of marketable securities, commercial paper, foreign currency. I think the talk was with the net accounts receivable.
That's right, and there was a little bit of discussion around that, but the important, I just want, once again, to step back and look at this very high level. Remember what we talked about, there were 2 measurement dates, right? And 2 key factors here. And we'll get into the cash in a second. But the takeaway from, I think the slide would be that when you look at the balance sheet, don't say, here are my cash or cash equivalent assets, and here are all the remaining other assets. That's not the way the test works, right? You look at the earnings and profits. You basically look at the there's cash, you look at the cash, you calculate, and it's historic, there's 2 measurement dates there for cash, which we'll discuss very shortly, and I don't want to jump to. But in effect, you could have a situation where your cash asset might be bigger or lower than what you anticipated when you calculated compared to the pro rata of your balance sheet. Okay, so it's a little bit of an anomaly, but the way this test works is you're going to determine your cash asset or cash equivalent. You're going to tax it at 15.5%, and then the remaining EMP, what's left after you've taken your cash assets into account, is how you calculate the 8% tax on that. Sorry, go ahead.
Right, so net AR means AR over AP. Aggregate foreign cash position is the higher of the average cash position at December 2015, December 31st, 2015 and 2016, or December 31st, 2017. So different measuring dates for fiscal year, so for purposes of this, we're just in calendar December 31st.
We don't want to complicate it any worse. So 2 measurement dates, right? You're measuring at the one date, on the one hand, you're measuring the accumulated earnings and profits. Remember November 2nd, 2017, and then you also have December 31st, 2017. That's one measurement, one analysis you have to do. And the second analysis you have to do then is your cash measurement date, right? So on the one hand, you take your ending balance for your cash and cash equivalent assets as of 12/31/2015 plus the balance as of 12/31/2016, and then you divide it by 2. And then you have to basically look at the ending balance of cash at the end of 12/31/2017 and see which balance is greater.
So look through for interest in partnerships and foreign FDEs owned by specified foreign corps, and anti-abuse rules apply, of course. So this is disallowance of the foreign tax credit. 965G is the technical code section. No credit will be allowed under 901 for the applicable percentage of any taxes paid or accrued with respect to the amount for which the deduction is allowed under 965. So essentially it comes out to these percentages of cash and non-cash, I think.
And the reason it's important, they're giving these percentages, right? Because at the end of, when you're calculating, when you're converting, let's say, from the deferral regime to the participation exemption regime, and you're calculating the deduction that you would have, or the taxable rate at the end of the day on the cash or the other assets, remaining assets, or remaining EMP, I should say more specifically. What they did was they gave you a percentage there of 55, it's effectively a 55.7143%, right? A deduction on the cash assets, and it's 77.14 or 77.1 deduction on the other assets. And so that's why you see those rates up there, because they're also used for purposes of deduction. And then in order to get to that number, right? You're saying how they come up with this deduction number, and the way they did it was they took the tax rate, which is 35%, subtracted the 8% for, actually, sorry, let me step back. Let's focus, actually, no, I'll do that. The non-cash assets, because it's a lot more simpler arithmetic from a mathematical perspective. You took the 35%, subtracted the 8%, and divided by the 35% to get to the effective tax rate for the non-cash assets of 77.14. So that's where they're pulling these numbers and for the deduction. Sorry.
Tom figured this out by himself.
Well, the one thing is, you know, there's been a couple of notices, right? 2018, I think -6, -7, -13, -26, and then there's also Q&A that the IRS decided to answer a couple of days before the deadline in April. Remember that one? And there they elaborate a little bit on some of this information. So, and there are examples, right? There are examples for the different variances, and they were helpful. I mean, a little bit, you know, we were a little bit under the gun in the marketplace, but they were definitely helpful. Okay.
And also, I mean, we'll mention this later, but their filing procedures and just, you know, what you're attaching, it's there, but it's still get
The lawyers will make a lot of money on litigation.
You think?
I guarantee it.
So Section 965H gives taxpayers the right to pay in installments. It's 8% of the total liability for the first 5 years, 1 to 5, and then it's 15%, 20%, 25% for years 6, 7, and 8. Right? So the first, which is already passed, has been due with the date of the return in first year, so without extensions. So that's why there was that whole, you know, frenzy and commotion to try to get the payment in for the U.S. shuttles that were subject to the tax. And I think the IRS came out with a notice or something like that, that you couldn't, your extension payment, you had to pay the 965 separate. So that caused a lot of havoc too, because a lot of clients, they pay their first quarters with the extensions, right?
So yeah, so it was, you're right, I think it was the Q&A that basically specified that you have to make 2 payments, right? One is your regular income tax liability, and the other one is your repat tax, right? I mean, not the repat tax, but like, let's say if you're subject to repat tax, the first installment of and you elected to take the installment method,
Which majority of them,
you basically had to make a separate payment in that respect. What I want to footnote here very quickly is that, you know, this is an election, and there were a couple other elections that you could have made, right? And one of the election was 965I1, which was S Corp shareholders elected to defer payment of net tax liability under 965. We talked about that S Corps have the opportunity to defer until there's a triggering event. However, they still need to have on file, they still have to report, I think. There's a statement that they provided in the Q&A of let's say, the repatriation tax they might be subject to. The other election is 965M. It's basically statement for REITs electing to defer inclusion under 951 by reason of the repat tax. And then the last one I want to mention is 965N, which is an election not to use NOLs under 965N. So you don't want to erode NOLs if you don't have to, right? That's one of the planning opportunities.
and there's I think in the guidance in the Q&A, there's the white paper attachment that shows pretty much electing under this section, check, electing under this section, check. So I think come return filing, we want to pay attention when we're actually collating everything to file. Because there's no actual form, these are all just white paper. Election to pay the installments, IRS Q&A, like we just mentioned, there's a detailed white paper statements with the 965 calculation. There would be no interest on the installment payments for now. And most states have indicated they won't allow installments. And like I said earlier, that was the biggest blow to a lot of taxpayers, because what happened is their federal payment, even with installment, was less than the state payment that they had to pay as a whole, so that definitely was not good.
I think you go to the farm tax credit section because we covered it.
Yeah. So pretty much this is all what we just talked about, but.
Okay. Are there any questions on what we just discussed? No. Should we take a break?
Yeah.
And then,
We'll take a.
And then put up the plexiglass so things don't get thrown at you.
We could change our mind.
so you're gonna go through the forms.
Some of the stuff.
Hey, Harold, let me ask you a question. Why did they, on the 21%, exclusion of gross income, why did they exclude personal well, accountants, lawyers, or
Yeah.
And realistically, we're putting a lot of information.
Being just.
It's
What's 199?
step back and ask
What's
questions.
199?
But I'm surprised because the email, they're usually like,
Usually there's people responding.
yeah, if they don't understand or
You gotta run through the same.
we have workshops a whole day, 2 whole days, 7.5 hours, 7.5 just off of.
They just pick it up, move it over, move it over.
Yeah, I think one of the,
The definitions.
It's eligible for?
Yeah.
Oh, so you had nothing to do with it, that was for investment purposes, this is for income tax calculation.
Yeah, I
It
know.
has nothing to do with it.
No, they just.
So they just, so in other
This is why I said, we were gonna withhold these courses.
You're right, right. I understand.
I spoke to the experts, I spoke to the law firm. They said, you make a mistake, now you change the C to S, whatever the hell it is. I will tell you, I'd like to know statistics. You're gonna basically.
Well, it is tricky because they're American. So
Yeah, this got millionaires.
if you only own it, yes, they're paying tax.
Well, they've never paid the AMT.
I'm not sure
They
about
never paid tax.
You never owned it.
They don't know what an AM is. It's a subway.
It's a geographical tax. But a lot of my clients, when I did the projection for 2018 under 2017 numbers, the ones who were paying the taxes aren't paying the taxes because they're gonna fall into the state of or they're gonna get the 10,000. So I don't think they didn't think this law through.
Yeah, I don't know if they're
Sale of 270 grand, which goes on to Schedule A,
Yeah.
Line 1. Income tax.
So there might be new guidance on that. That's why it's not definitive.
Required to pay it. You're gonna get 10,000.
presentation. We just received the emails of, I think there was 2 questions. One of them wasn't international related, but we'll read it anyways, and if anybody has, I'm actually not quite sure.
I think maybe it's something you touch upon, Howard. Are property tax deductions limited to $10,000 on a simple trust for 2018? Thanks.
Yeah.
So the answer is
All
yes.
taxes
Howard
are
said
limited to 10.
And there you have it.
This is what people don't realize. It's income, sales tax, and real estate taxes. 10 grand, that's it.
Okay. And
Thank you, Howard.
Thank you, Howard. The second question was, what is the year of inclusion for taxpayer when taxpayer files return on calendar year basis if CFC has fiscal year in home country? I would say here, since you're filing in the U.S., you have to follow the U.S. calendar
Yeah,
date.
they have there's a whole section on
That's right.
on fiscal years.
That's right.
I didn't bring the article with me. There's a whole section on fiscal.
It's that was
Still, what was it, E? No, it's section 1. Talks about the fiscal
fiscal
years.
calendar. Yeah. And the only other thing I wanted to mention quickly was, which we overlooked, and it just it didn't make it to the slides, was if you have a 1240E transaction, which basically means if a U.S. company sells the shares of its CFC subsidiary or subsidiary CFC. In that instance, if there's any gain on it, it would be deemed dividend for U.S. tax purposes. But if you recall, we talked about participation exemption, and so 1248 gain on the sale of a CFC stock could potentially benefit and be tax-free when it comes to the U.S. under the participation exemption regime. That's something that's a very high-level statement, but that's one of the benefits of also of participation exemption. So before we proceed, is there anything you want us to elaborate a little bit on the previous session we just discussed, or do you have any questions that maybe you came up during break and you want to ask? So let's just, one of the things when I saw this section was, okay, this is going to be a short-lived provision. I said, you know what, it's going to be 1 year, 2018, when everybody's going to be rushing to get it done. But then we talked about calendar year and fiscal year, so people are going to be calculating it also probably in 2019. But the one thing I also want to mention was that, you know, while there was a rush to get the repat tax calculations completed for some, you know, by 315 or 416, 417, whatever.
If you are an extension.
That's exactly it, right? You go on extension. So
You haven't
now,
got a good summer.
yeah, when people have punted on things, especially the S-corps, this is when people are really going back and reviewing those calculations or redoing those calculations or actually running those calculations.
I think there's also a big change coming in 19, which we won't worry about until 20.
Yeah, I'm not sure about that one. The only thing I wanted to caveat was that there are also clients that haven't been able to, because like large multinationals, haven't necessarily been able to track their EMP properly, as you mentioned at the beginning, and they're still in the process of running or accumulating I shouldn't say accumulating, but, you know, calculating the earnings and profits of past years in order to come to a current year number. So I'm seeing it where you have companies that we're still running repat calculations because they haven't completed EMP. So it's still current. It wasn't something that was done prior to 315, 417, or something that I'm willing to wager is probably going to go beyond 915 also. So. Go ahead.
How is the government gonna, are they gonna audit this heavily? Like, how do they, like, if you're talking about numbers in a foreign country, is the IRS actually gonna go to the foreign country?
No.
How are they gonna control this, or?
Well, there's two sides of the two flips or two sides of the coin. On the one hand, you should already have provided all that information on previous filings you've done in your 5471s, right? So there's an assumption there that they were done correctly in the past, and therefore you could easily substantiate those numbers. However, if it's done incorrectly in past years, you've rushed now because the repat tax you knew was going to affect you. You've rushed as a company or an individual that has, let's say, an interest in a CFC. You've rushed to get that information. And you've gone back and you've calculated the earnings and profits to the best of your ability, right? And I'm not sure how they're going to audit this, but in fact, if it does come down, you have to have good documentation in anything we do, right, in our field, to substantiate an audit.
You have an October fiscal, what are the dates you use to do your calculation? I assume you have, until you file your October 18th.
Yeah, I kind of wanted to stay
That
away
was a
from.
slide you skipped over, wasn't it?
No. This is a whole discussion we skipped over.
Some dates yet.
No, it's so if, let's say, so we're talking what,
October 31st, 18, I guess, is when they're gonna have to do their calculation.
What's 958? They repealed it.
no, I'm sorry, 1 second. So
I assume you do it on October 31st.
you do it, but you
18.
have to do it, you have to take into account the months when this was adopted, right? So in that case, you get affected for the period. You have to, the complication here really becomes not necessarily the fiscal year periods, the different corporate income tax rates you have to use, right? Remember that if you're on a calendar, you're at, let's say, a higher rate in 17, now you're having to look at 18 rates. So in effect now, you're looking at a potentially blended rate, where there's also actually, there's some ruling, there's additional information in the rulings how to go about this.
With the 15.5 and the 8, that gets.
That's right,
blended.
that's how it gets split.
Well,
And
I
it's,
kinda figured that.
yeah, and you have to, and that's where the model gets really complicated, the way we talked about, right?
Good.
Because on
Can we bill
the,
our clients for that?
pardon?
Can we bill our clients?
Absolutely.
For that? Howie, is that something we can do?
Depending in New York, I think you have to advertise it first. I'm kidding, I don't know anything about it.
I do have another question.
Go ahead.
You have 8 years to pay it.
That's right.
Is there any reason why you wouldn't take the 8 years, or did the government give you any incentive to pay it all at once? Like a discount? The government's great at, a cash basis, they wanna.
I would, I mean, it doesn't make sense, right, unless somebody just wants to get rid of that, they want to get rid of that liability right away. I mean, that's not a good answer. But if I'm going to step back and think about this, there is something we discussed about triggering events, right? And so my feeling on this would be that in case you miss a payment, there's a triggering event, and all of them get caught up front, right? So. Do you want to, you don't know what your performance of the company will be in later years. You don't know where your cash will be available in future years. So you kind of beholden to this agreement now that you have to make these payments to the IRS. So it's.
But the IRS, their theory is, you take all the money the first year up from people, they're not gonna have any money to spend.
It covers the
Sounds like my
transportation
wife.
expenses for the president.
Like I
So they're spreading it over an 8-year period. They're saying you could pay it off earlier, but maybe the election should have went to reverse.
I think what you're looking at is a situation where, like you said, things were done very quickly. People might not have the cash on hand. There were plenty of multinationals, your Apples, your Amazons, which are offshore, have immense accumulated earnings and profits, and asking them to immediately now, within 2-3 months, come up with not only running the calculations, but also come up with the number, with the cash in order to pay off for, let's say, billions and billions of dollars of earnings and profits, which have been parked offshore for the last 10, 20 years. I mean, if you really want to think about it, Subpart F or deferral regime has been in place since 1962, 1963 during the JFK era. If somebody, right, but your earnings and profits were going back to 86. So still, go back to 86. Think about all the internet companies that came about in 86. Your Apples, your IBMs, and IBM was before, but still, there's plenty of them that came about during the internet bubble, and it would be a significant tax bill all of a sudden we're asking these guys to pay. I mean, you've seen the articles in last year or the year before where the EU Commission was going after Starbucks, Apple, and they're going after them, basically saying, hey, you're getting subsidies in Ireland, and you have all these regimes.
Well, Google just got hit for $5 billion.
Antitrust.
Yeah, but that's a little bit different. But see,
Fred's gonna give him a check. Right, Fred?
As long as I'm on the payroll.
He's gonna lend them at the AFR.
so did that answer?
Sort of long term.
Okay. Was there another question?
No, I just, 958, I was having, and then the foreign tax credit, they changed it.
Yeah, the foreign
You're
tax.
gonna go through that.
That's right. That's right.
So we just highlighted a couple of things with a couple of other items with international tax reform.
Oh, one second, sorry. So, the reason part of the notices came out and looked at fiscal tax years, right, was because everybody, right around the time this was about to go live and be adopted, right, in late, I think in November, but late last year, people were coming out and tax planning strategies in the marketplace saying, hey, convert to a fiscal year, convert to a fiscal year, so this way you don't have to worry about paying the repat tax for 2018 for 2017. So, and there's actually guidance on there, and there's actually even if you went out and were a little bit aggressive and tried to take advantage of that strategy, they really stepped it back.
They were quick.
They were quick on this one because they realized. But the other thing I wanted to come back to, I'm curious how they're going to enforce this myself. I mean, I'm curious to see if they have the bodies, because remember, there's a hiring freeze on the IRS, right? So you have to train these people now, and then you have all.
They're gonna call out the National Guard. They'll do the job.
It's not like you train somebody real quick.
No, you're right. You're right.
Just, intense stuff.
So you might have some clients wanting to roll the dice, but
I'm not hearing that.
Yeah. So foreign tax credits under this new, and I should have put in quotes, territorial tax system. Dividends from CFCs to U.S.
I'm sorry, it's not a territorial system, sorry. It was
Those
supposed
quotes.
to be a territorial system. It's a hybrid system, right? In the sense that it's a mix. You still have subpart F that's still around, right? And you still have, you're still taxed globally on your income. And there are still sourcing rules here.
Yeah. To U.S. corps, they won't be subject to U.S. tax. Therefore, there's no indirect foreign tax credit under 902.
And we write it off as entertainment?
I think we did a presentation on that one too. The foreign tax credit under 960 still applies to subpart F. Source rules for inventory.
Can I interrupt for
Yeah.
a second? Sorry. So the takeaway here, right off the bat, I would say, do we know, are we all comfortable here with the foreign tax credit rules and the differentiation between a direct and indirect foreign tax credit? The direct so the direct foreign tax credit is in effect, let's say, a withholding tax that you pay, right, on a distribution or a royalty or interest or rent that's being paid by the foreign entity to the U.S. Some jurisdictions have withholding taxes on those payments. So in effect, under the old rules, you would be able to take a 901 credit. The other thing people used to do, and it might still be an option, it's something to keep in mind, is in case you still want to take advantage of local taxes you're paying locally is you have to check the box regime, which is still current. So if you have a entity that's eligible for a check the box election, in effect what you do is, you treat it as a branch by making an election to treat it as a foreign disregarded entity, and in that instance, you take the taxes that you're paying locally and they count as 901 direct foreign tax credits. So 902 really looks at the taxes the subsidiary, the CFC, pays locally, and it says, you know what, those things you can't take the indirect foreign tax credit anymore. The reason I wanted to make that very clear, because that's a very important change. There's two other things that's important to note there when it comes to foreign tax credits. Is the first one is that 960, like it was mentioned, was any taxes. So if you're paying indirect taxes locally that are basically were resulting as a result of the subpart F income that is a deemed dividend in effect, then we still could get this indirect. We could still get some of the local taxes from the local jurisdiction in the U.S. Okay. The other thing I wanted to mention was, don't be sure you're going to get the 901 credit, the direct credit, if you're a C Corp and are taking advantage of the participation exemption. Participation exemption basically says that any distributions coming up from a foreign jurisdiction or a subsidiary to the U.S. is tax-free in the U.S., but you no longer get the 901 credit because there's no tax on it. So the withholding taxes you're paying locally are gone. You can't credit it. The only thing you could probably do is start planning in order to make sure that you're in a favorable jurisdiction, which under the local laws or under the treaty does not withhold on dividend distributions to a C Corp. It varies, though. If you want to talk a little bit about distributions to an S Corp and qualified dividend. Sorry.
The source rules for inventory, under the pre-act law, the source of income for sale of inventory property produced in the U.S. and sold outside the U.S. that can be treated as foreign source income. So for the years that began after 2017, the source of income from inventory property produced in part in the U.S. and in part outside the U.S. must be allocated based on the location. Title passages are no longer relevant. So
a lot of times what happened was in the past, this is a key provision when, let's say, you had excess foreign tax credits. And so what do? You have to play with the limitation in order to be able to take some of those foreign tax credits. Because remember, you're basically in the past, or the foreign tax credits carry forward 10 years, right? So you want to make sure that you use up as many of them because they're dollar for dollar. So in effect, what you have in the past, you were playing around with the sourcing rules in order to increase foreign source income to be able to offset the credits which were in excess in the past. So that was part of the planning strategy. I think one of the ways that also you were able to generate, still possible now, to generate foreign source income, and I haven't dealt much with it, was IC discs. IC discs was a way to generate foreign source income in order to take advantage if you have if you had excess foreign tax credits to use up.
And a new foreign tax credit basket is created for the income from foreign branches. Income of a U.S. taxpayer that is attributable to qualified business unit must be allocated in their own foreign tax credit basket. Changes to subpart F. I think this is, in addition to the 965, this is also another headache, we can call it, for our clients. The new category of subpart F will require U.S. shareholders to include the global intangible low tax income, GILTI, of CFC's and current U.S. taxable income. So I know as Chip mentioned, that slide that had territorial, even though it says they want a territorial, it's a hybrid because yes, you have this participation, you have this 965, that now when you bring money back, it's all PTI up to the extent of what you reported, but at the end of the day, now your CFCs, when we go through the guilty mechanics, you're reporting an amount of the earnings on your U.S. tax return. So that came into effect, and it will be worse off than before.
So there's a couple of takeaways here. Remember we talked about participation exemption and how it was great that the government gave us an option here? Well, that option was trickled down, or trickled back, I should say, with the guilty provision. So in effect, before, you can't say that any distributions that come up to the U.S. are going to be tax-free. Yeah, they're going to be tax-free when the U.S. entity receives, the U.S. corporation receives it. But before they do that, before they distribute those earnings and profits, they have to take into account guilty. Now, as I mentioned when I first started, I think one of the things we will see in the coming months is regulations around guilty, and there will be piecemeal, and that will be welcome because we'll have a little bit of better understanding of this provision. But my feeling on this is that I think originally it was intended in a very limited scope and wound up having a very broad use. So now you have the way it's calculated. You calculate your subpart F exposure. Right? So you're looking at subpart F. And after you calculate your subpart F now, then you have to also calculate a guilty tax on it. And by the way, if you're not a corporation, C Corp, you're going to pay 21% on the guilty income. Now, if you are a corporation, you could potentially pay 10.5% on that. But the reason I bring this up is because look at the title of it, Global Intangible Low Taxed Income. Right? And I think the definition, did you talk about the definition quickly? I mean, it's below, but it was supposed to be intangible income, and now the way they define it, they're saying anything that's not aside from your regular business,
your tangible
everything
assets.
is intangible. So
Yeah.
we're going to tax that. And so it's all encompassing.
So I think this was meant more for those foreign corps with IP and patents and all that. But at the end of the day, a lot of CFCs have X amount of assets, and the way this calculation works is it kind of goes backwards. Even though it's called guilty, it's driven off your tangible assets.
And it's interesting you say that because, I mean, you already assume that if they were worried about IP companies, you already have a provision within the foreign personal holding company income, which is passive.
Yep.
It targets passive income. And in that instance, they would do something about to take away some of the exceptions under
that
provision in order to, tackle that issue of the IP regime, or IP companies. The one thing as a footnote I'd like to see, because now people are saying, well, since we have a low tax rate in the U.S., maybe it makes sense to have the IP in the U.S., right? And
Treasury Secretary says that we'll have a fairly comprehensive set of proposed regulations by the end of the calendar year.
Which year?
this year,
He didn't say.
they're talking, right? They're saying
Yeah.
September, October on guilty, potentially, with a couple months delay. So we're looking here at getting something. The one thing though that I was hoping you brought up, you'd bring up, Howard, that I think end of last year, beginning of this year, there were also proposals within Congress that the U.S. was going to adopt an IP regime here in the U.S. because you've had so much intellectual property that's been bifurcated and sent offshore, right? And this would be a way to bring it back and also generate more revenue that would be taxable in the U.S. But sorry, I'll hold off.
That's what Harder is talking about. The different regimes have to meld together.
I'd like to see that. When that happens.
That's what he
Well,
said.
remember, what they say and what they do it could be different. Because remember, when we started this whole discussion, territorial system, subpart F was supposed to go away.
Yeah.
We're still talking about subpart F.
Gone. But
The only thing of subpart F that went away is the subpart F section dealing with oil and gas companies. Okay.
Then they just recently changed 911, 911, section 911, on the overseas housing for people working overseas.
What was 95,000, something like $90,000.
The 100 and,
It's
damn,
100.
went up quite a bit.
Okay. So now I should move offshore. And I'm not gonna be taxed. Okay, cool.
Well, it depends if Putin is playing golf.
So I think like one of the takeaways from this slide is like we just highlighted or illustrated is like this guilty, it's still unraveling, and we're doing analysis and calculations and estimates, but at the end of the day, there's nothing definitive until the regulations come out, and I think as Chip mentioned, they're coming out in steps, so we'll see more as it comes out. But
Did they say that this was supposed to get so easier, just like the other?
yeah,
Is this supposed to be easier?
it-
Or is it just for generating cash? Or a little bit of both?
I don't.
The government concept.
Are we talking-
What was government kind of thinking on this?
They weren't.
No, you know,
Another
we
postcard.
think they are, but if you think about it, it's actually brilliant. And I'll tell you what, let's see what the unintended consequences are at the end of the day, because there's people in the industry that are saying that this is not gonna go about and bring back jobs, it's actually gonna shift them offshore, right? But in effect, what they're doing is they're saying, okay, we need money in the US for various bills that we have. The one thing is, we take the earnings and profits, we take that deferral regime, which we plan on abolishing, what we should talk about doing away with at the beginning, but we keep it in place. And now we're gonna give it extra muscle. And the way they gave it extra muscle, they said, everything you've deferred, right, for the last 10, 20 years or longer, we're gonna tax it, we're gonna have one-time tax on it. 15.5 on cash, and then 8% on the remaining assets of that EMP, okay? And then, on top of it, so you know, we're gonna also take away your deferral regime and all your deficit planning that you were doing for US tax purposes in the past, right? Because you were generating deficits with intercompany transactions. And we're gonna put now the tax system on a current year footing. And how did they do it on a current year footing? By putting in place this guilty tax. So whatever you're doing offshore, you might be planning around subpart F, but now you're gonna trigger guilty. So at the end of the day, there's no point of you doing deficit planning if you're trying to artificially create deficits or trying to do things around that, because now you're gonna have guilty hit you if you have earnings and profits.
yeah. Like this guilty establishes a minimum tax on the regime that applies to U.S. Shareholders on a certain return on their tangible assets. So this now, I guess, a good point of this is we're calculating your 965 and calculating your accumulated EMP. Some of the adjustments include depreciation and ADS. So now with guilty, clients, as I know somebody mentioned, we're at the mercy of the clients of if they have a CFC, how are we supposed to get the information? So this is going to be important with calculating the asset, the tax bases of the ADS, right? So it really, that's going to be another communication / maybe problem down the road for getting better numbers. So, and as the slide says, in computing guilty, U.S. shareholders must determine their U.S. tax basis of assets held by CFCs. This is another point. For 2018 and future years, the definition of U.S. shareholder has changed. Any U.S. person owning more than 10% of voting power, and this is the addition or value of a CFC subject to the subpart F rules. So attribution rules, they've also been expanded from what they were before. And I think you mentioned this point actually, the anti-deferral rules that apply to CFC for oil and related income has been repealed, and that's the only thing that made it out of the whole subpart F. So base erosion anti-abuse tax, I'll be honest, I haven't had pretty much any experience with it, but I think Chip has. But this was meant to prevent erosion of U.S. tax base of corporations making payments to their foreign affiliates. So the deductions may be restricted under the BEAT provisions, and they generally apply to things we would look at with base erosion, interest, management fees, royalties, stuff like that.
So this BEAT's very important in the context of inbound transactions. So if you have a foreign parent company that owns a U.S. subsidiary, and the U.S. subsidiary borrows money, right? Potentially here, what we're looking at is this BEAT tax. But what I tell my clients, because you had other, let's say, competitors that would go in the marketplace and say, oh, there's a huge fire here, it's called BEAT, and let's make sure do all this analysis that needs to be done around BEAT. There's a common sense.
Medical marijuana.
There is a common sense approach here. In the common sense approach, you have to look at the test before you even start calculating tax and worry about BEAT. And it's very specific because in order for these companies to be affected, the rule is that you have to the test is that you take the average annual gross receipts of the last of at least $500 million for the last 3 years, ending in the prior year. So in this case, I would basically take all the average receipts if they're over $500 million over a period of 3 years, ending in my prior year. So the way I'm looking is I'm looking at the receipts for end of 2017, 2016, 2015, right? And if they're not over to combine over $500 million, then I don't trigger this test, right? There's a second piece of this test, which I think is the thing that you also have to have sufficient base erosion percentage, which is 3%, and no point in going even in that calculation because it's complex. Because if you don't have $500 million, or at least $500 million annual gross receipts, no point in talking about this. The only thing I'm going to caveat that you don't necessarily just look at the U.S. sales of the subsidiary. You also have to potentially look at effectively connected income that the foreign parent might have in the U.S. also. So let's say, hypothetically speaking, BMW, right? BMW US has 400 million. It has probably more. I don't know. It's not one of my clients. It would be great, but if it has $450 million worth of on a cum basis of annual gross receipts over the last 3 years, and then it also, I think I'm safe under this provision, but I've ignored the effectively connected income that the German parent might be selling directly. And then let's say if it's in excess of 50 million, then you know what? I triggered BEAT and I didn't know. I didn't pay attention. So it's important because there's general rule and there's also nuances you have to take into account.
So it requires a calculation of minimum tax, compares to 10%, not including deductible payments to foreign affiliates, with regular tax liability, including such deductions and certain credits, where the 10% amount is greater. So it would apply to payments treated as cost of goods sold or payments that require no markup under the transfer pricing rules. And the reporting or BEAT would be done on Form 5472 and will trigger a $25,000 penalty per form. And as you know, it's been increased from $10,000. So these foreign forms are now, I think in the past, majority of them were informational, but it's getting more and more important that they're really reviewed because there's income items in addition to what was done in the past.
So the one footnote here is if I do have a BEAT concern and I'm looking to get around it, plan around it,
yeah.
I'd probably say I look at the transfer pricing rules. And so I don't have to worry about having intercompany transactions, whether they be, let's say, loans, intercompany loans, or intercompany licenses, license payments. Now I can specifically look if I could somehow claim that the U.S. is benefiting from some sort of good that there's a markup on, right? And it's buying it. So that's your COGS plus margin from a transfer pricing perspective. So transfer pricing is when you have intercompany transactions, there's exchange of intercompany transactions, and in effect what you have to make sure is that those transactions are done at arm's length. And so in that instance, it's as if you're dealing with a third party. So in that case, you have to look at transfer pricing, the 482 section of the code, and it's a fairly complex, section, and it tends to have economists that really deal with this and run models and the likes. But in fact, what it's saying here is that you have cost plus markup is a way to get around to, it's maybe a planning opportunity.
The
when it comes to
IRS
Round B.
beat up the international section very largely.
It did? Okay.
That's where they're putting most of their money.
Okay. They have to pay salaries.
Because of this, I mean,
Yeah. So a lot of these slides that we have, they're very, very highly condensed. And we could spend days on just 965 alone. So we try to put as much information just on the updates and, so at least you're aware of what's going on and if there's any questions or more here.
And that's not even touching fiscal years, right?
Exactly.
And,
Yeah. So we all know Form 962, we're familiar with it. I should go back. Right now, we're going to go over a couple of foreign forms, 926, 5471s, and I believe 5472s, and then I think we go into guilty, so maybe hopefully we'll have time to just touch base on the mechanics of that, just high level. So, what is Form 926? U.S. citizen, resident, domestic corp, domestic estate or trust must follow 926 to report. Generally, it's any exchange or transfer of property to a foreign corp, described in, I don't want to read out all of it, but 6038BA1, 367D, or 367E. And special rules, of course, apply for partnerships, and I'll go into a little bit more detail on that.
Has anybody done work with 367? So 367 really focuses on outbound transfers. So you have instances where, whether it's individuals or mainly corporations here, but where a corporation transfers, whether it's the shares of a subsidiary to a foreign subsidiary, or intellectual property, that's 367D. And then there's also 367A, let's say if there's assets that, tangible assets that they're transferring, there may be a gain on it.
Yep.
So in that instance, 367 is a total tax on outbound transfers when you're taking assets out of the U.S. and moving them offshore. That's what it was intended. Because remember, we had a deferral regime before, and that deferral regime encouraged people to shift operations and assets out of the U.S., income-generating assets, because that could basically generate that could be taxed as a lower corporate income tax rate, or have some sort of other planning opportunities. So in that instance, 367 came about in order to basically impose a tax on, impose an exit tax. The one thing that we'll go into, and I want to mention this quickly, is there's a gain recognition agreement, which we'll touch upon briefly. A lot of times when you have restructurings, right? And so let's assume that you have a U.S. parent company that has subsidiaries across the board. Has Ireland, has Germany, has France, has Italy, and it holds it directly. That's not a very efficient way, right? Because at the end of the day, in the past, those countries probably have individual tax treaties with the U.S., and they could have various withholding tax rates. And so whenever there would be distributions or any kind of cash coming up from those foreign jurisdictions up to the U.S., there would be withholding taxes on that. So what was done, what the U.S. entity typically did, it put a holding company in a tax favorable jurisdiction, which would be allowed to move the cash around a little bit more tax efficiently, both from a withholding tax perspective locally, but also from a U.S. tax perspective. And in effect, what you would have is transfer of shares from the U.S. of the foreign entity to another foreign entity. A gain recognition agreement basically says, okay, we'll track that gain, But if you enter in disagreement with the Internal Revenue Service, right, and you have a statement, a 367 statement behind your return, right, behind your 1120 there, you're basically saying that while you're tracking that, you commit to not do any other transactions or sell the to a third party. And as long as you're not, as long as you don't sell the stock of the shares, the shares of the entity you just transferred, in that instance, you will not trigger the gain for 60 months or 5 years. So you're able to do that. And there's other things where you have to look in, if you continue to transfer the entities down the chain and the likes, you still don't trigger because there are exceptions under 367. It's massive. But in effect, it allows you to forego the tax liability that the exit tax under 367 would impose by entering this agreement, as long as you don't go ahead and trigger it or sell those shares to a third party. So sorry, I took you through a whole thing, but it's important to understand 367 and the exit tax on it.
And I guess to shift it more even to closely held businesses, 926 is, I think it's important because a lot of our clients, they contribute or they put assets or even money to a company abroad, and they don't think it's anything serious. But I think the 926 is a good indicator because that leads to other forms generally being required. And as we know, with a lot of these foreign forms are interrelated with, if you're putting money into a foreign corp, most likely a 5471 might be it might exist, and then if a 5471 exists, on the 938 you're marking exception reporting that you're filing a 5471. So there's a lot of duplicate reporting, but everything kind of has to be in sync. So we take it upon ourselves to, I don't want to say annoy clients, but we're very, very careful with when they do anything offshore with just a simple, oh, you know what, I put this asset in here, that could be something, and they're usually not sure.
So let me ask you this: do you do a 926? Then, let's say when you form a new entity, some of those countries require that you have to have
Put something
capital,
in, yeah.
you have to put cash in there, into the capital account somewhere. Let's say assume in Luxembourg it's 12.5 thousand euros. You do a 926 for that? Yeah. You do?
And I know some our international practice, it's almost like you're not hurting yourself if you're reporting with certain forms like this, but generally you wouldn't need to.
So okay, so I'm going to test you again. Oh, sorry. Go ahead.
Client has just come to me with a $10,000 fine for not filing 5471.
Okay.
Had a subsidiary in another country which was completely inactive for about 3 years prior to the filing of the return.
So it's dormant.
Dormant.
It meets the dormant rules. There's certain rules in there that
It looks to me like they were required to file the 5471.
I think you're required to file regardless if you're dormant or not.
I was hoping you'd say something else.
Yeah, but I think you could try and make an argument that it was dormant, it wasn't inactive. I'm not sure if it would be a successful argument, but
Omaha is pretty tough on that, aren't they? The Omaha office?
I'm not sure. I couldn't tell you that specifically. But what I can tell you is that you do have a filing obligation, right? And there is a section, usually a 5471 is several pages. When it comes to a dormant entity, you have to look at, there's an asset test and an income test. I think the income is 10,000 or 25,000, whereas the assets.
There's also a cross-check on all 5471s. That's what set off, one of the big companies got picked up because they weren't filing the 5471, and they did a cross-check.
I'm not sure about the cross-check.
I don't know who
One of the biggies.
Yeah, they probably have programs to do that, but there's a section on the first page of the 5471 where you can check in and it says that the entity is dormant. But once again, you have to make sure that I think you can't have an excess of $250,000 in assets and 10 or 25,000 in income for any current year. You have to look at those. Otherwise, you can make an argument, but a couple of years back, when people were not necessarily filing the 5471s, and the IRS wasn't necessarily enforcing them. They gave people a heads up saying, this is coming the road, and going forward, we're going to enforce this. I think in their tier 1, 2, and 3 issues, and
I would
it's just
do
a
it
result
before
of it.
September 28th.
Pardon?
I would do it before September 28th.
Okay.
I just had an IRS audit, and they literally got selected for not filing the 8938s. The income was reported on the 1040s, which was essentially our saving grace, and we were able to get $20,000 of penalties abated due to reasonable cause because the income was reported. And the IRS agent specifically said to me that as long as there's no, defrauding of the government and not, reporting the income, that they are likely to abate penalties.
Remember one thing, the 5471
It's different, obviously, but
is
still
an information return.
Yeah, which is same as 8938.
But in the 8930 I think on the first page, it actually pulls certain, if it's foreign source, your interest, your other income, your dividends, so like you
Yeah, the income was reported, but on the 8938 wasn't filed at all.
Okay.
So I mean, we basically just filed it and had like a quiet disclosure essentially, but they were audited and they were assessed the penalties, but they abated, so.
Might want to give it a try.
Should be okay.
Compliance is 90% of the game.
So the reporting thresholds, the U.S. person that transfers cash to a foreign corporation must report if immediately after the transfer, they hold directly or indirectly at least 10% of the total voting value of the foreign corp, or the amount transferred during the 12-month period of the foreign corp exceeds $100,000. So I might have misheard your question.
No,
but
no.
like for example, an individual, if they get a K1, I think it's common if we move it over to the individual side with a lot of clients that we deal with. On the K1, these hedge fund K1s, they might have on the statements that this contributed to these foreign corporations. So you're using the pro rata and just seeing if they fall under the threshold. Because usually when you split it up, these hedge fund K1s, it ends up, even though the partnership might have contributed $500,000, if you split it up, it ends up being less than in percentage, and also the cash transferred. So it gets subjective, especially with individuals and K1 pastors. Yeah.
Well, you end up with a lot of individuals with a number of K1s.
Yeah.
And is that 100,000 to any one corporation, or 100,000 cumulative? Like you might have, if you've got like 5 K1s, and there's like, let's say 25,000 that's gone to foreign corporations, that would be 125 for the year. But is it 100,000 for one company, or is it cumulative 100,000?
It's to the foreign corp of the person.
So if you had
So if
5 partnership investments and 25,000, each one was 25,000 transferred, you wouldn't have a 926 then?
I just thought it was the aggregate, like the FR. As long as you hit that 100,000 threshold, you have to file for all of them.
Are you saying, are they separate entities?
Yeah, like five completely different investments from 5 different partnerships, 25,000 each. Like I was thinking it also was 100,000 that you as an individual transferred 100,000, not necessarily just to one corporation.
I always thought it was per corp, per foreign corp, but we could check that.
Look at the instrument.
Yeah, the F bar is in the aggregate.
Yeah, but I thought it was similar to that, like it was in the aggregate, like the FR is in the aggregate of 10,000. This is an aggregate of 100,000 or more.
Make an assessment. I've never had a guy go over 100,000, either in aggregate or to one company, as a small investor.
And also, I think that's important too, and with the also 10%, but that's rare. I think it's usually you get to 100,000, you get that before you get to the 10%. Transfers by spouses, transfer of stock securities, which the GRA has filed. and distributions by domestic liquidating corps.
All right, so this is my question. I was trying to, sorry, I was just trying to remember my question, which I was going to pose. So would you file a protective GRA or not?
We would, right?
Yeah. Would you file a protective DCL? Dual consolidated loss statement.
Yeah. Or no.
We'll talk about that. I was just.
So, partnerships, and this, I think what you were alluding to, responsibility lies with the partners to file the 926s. A partnership should timely notify the partner of any transfers that may require Form 926.
So if you think about it, I mean, I would have to look at this, but if the responsibility of filing a 926 lies with the individual, and we're looking, I think then, somebody said it's in the aggregate, and it makes sense that if you're contributing, you're making 25,000, 25,000, 25,000, the responsibility is with the partner. Then in effect, what you would have to look at, depending on the vehicle that you're using, but in this instance, it looks like 100,000 would be the aggregate.
Because if you, I guess if you,
I would think it would go by the.
because they're all separate, like, let's say you see separate ones, then,
Separate
yeah.
investments.
Even though it's individual partners,
But
get-
it's the individual contributing the money off, right?
Yeah.
Who's reporting it? It's because when you're
yeah, but
transferring,
he's being reported on the K1, so it's a cross check.
we'll have to look at it.
Yeah, the attribution rules, you gotta, you know, and they're moving everything down to the partner level now under
But remember,
Separate.
but remember the purpose of the 926, right? It's in order to track any outbound transfers, right? So in an instance where it's a U.S. corporation transferring intellectual property to its foreign subsidiary, it's not the foreign subsidiary that's filing the somewhere in the 5471, the 926, right? It's the U.S. corporation that's saying that I transferred the intellectual property offshore and files a 926. In this instance, it's the responsibility lies with the partners. So if the partners and the accumulator are transferring over
a lot of
100,000,
rules have
have
changed
to
for
file
partnerships
926.
in the last year.
I'm not a
anyway.
partnership guy.
So are you,
I mean, I don't
are
know.
you filing one 926 or a bunch of 926s if?
There's a bunch of them, because you're listing the
Like for
foreign,
each-
the actual
For
name.
each company that you,
Well, I think like Nicole, you both made a great point, because the K1, I'm using the K1 as an example. It'll have 10 foreign corporations, and then you have 3 or 4 other K1s that have multiple other corporations, and it's the total contributed is over 100,000. So in the 926s, you'd have multiple that would show the name, but at the end of the day, the contributed amount in total would be over 100,000.
And technically, you are supposed to file one for every single
Yeah.
transfer, but I know in best practice, what we do is we'll do information available upon request.
Yeah,
And then
exactly.
we'll put like the total amount that was transferred, just so the monetary amount gets on there, and then just information available upon request. So you're not typing out, you know, we have clients that literally.
All right, so somebody in my firm that's watching this and does a lot with individuals and partnerships gave me the answer.
today, right?
So no, they just, you know, because I have to track in case somebody has questions. But one of my colleagues says it depends on how much was contributed to each foreign entity. Well, we assume this, we were talking about 100,000, but okay. It is per foreign entity, so Howard, you were right. So if 5 different partnerships all transfer to the same foreign corp, then you have one 926 filing. So I guess you bring it all together, and it comes out to the same answer, but you have to.
Depending on the ownership. though,
That's
too,
right, that's right,
Yeah.
that's right. All right.
But I guess
Thank
the key takeaway, if it's unclear, it's not going to hurt the taxpayer reporting it, right?
All right.
5471s would probably be more.
12 minutes to go. Last
So
one.
we'll blow through these, but 5471's information return of U.S. persons with respect to certain foreign corporations. Who must file? A U.S. person, that's a citizen, resident, entities, estates, trust. there are categories of 5471, 5 categories, but in reality, there's really only 4 because category 1's been repealed. But category 2, U.S. citizen, resident, officer, or director of the foreign corp, where a U.S. person initially acquires a 10% or more of the stock of the foreign corp. Category 3, a U.S. person who acquires 10%, acquires an additional 10%, disposes of 10% to reduce less than 10%. So anytime there's additional shares or disposition of CFC stock, Schedule O is always required. So that's always one thing that should be generated when a transaction like that happens. Category 4, a U.S. person has control of the foreign corporation for at least 30 days. Control is greater than 50% of the voting power. And category 5, a U.S. person is a shareholder in a CFC for 30 days in the year owned in stock on the last day of the year. So, and these 5471s, as we know, they're they're complicated, but you get hit with a $10,000 penalty as soon as they find out. And I think the biggest trigger too is if you filed 5471s in the past and you didn't file a proper extension, so your 5471s are late when you file your return. And we've had clients that have 10 5471s and we're still working on abating it, depending on reasonable cause, but it's very tough.
And filing blank 5471s. You know you have to file, but you don't have the information.
You know what to put on it.
Yeah. Doesn't get around the
multiple filers of the same information. One person may file on for people who have the same filing requirements. So it's not like a category 2 can file on behalf of a 4 and 5. That's not the way. It's usually the higher can file on behalf of the lower or the same. If that makes sense. So we'll just keep going past these. So here's the schedules. I'm sure we're mostly familiar with it. Schedule A, B, C, E, F. It has your income statement, your balance sheet. Schedule M of transactions. Schedule O, like I mentioned, is important for category 2 and 3.
So what I do personally when I look at some of these forms, I like to see if there's a flow or a consistency. So what do I mean by that? I look at Schedule M, which should report all the intercompany transactions, and that's where you have to look at subpart F analysis. If you have any subpart F, usually you see the flows in Schedule M. Now what happens is if you have transactions on Schedule M, now let's say you have a loan, right? And you have interest payments. Well, you hypothetically assume that interest payment that's reported on the Schedule M should also be visible or presented on the income statement, right? That's one. But don't assume that if there's an interest payment on the income statements, automatically should be also present on the M because it could be a third-party loan. The loan itself on the balance sheet, there's a section on the balance sheet in the 5471 where it says if it's from a related party, the loan, or to the related party. Once again, that balance should be reported on the 5471 in Schedule M. And it's the highest balance during the year that you have to look at. Right? So it's during the month. No, it's the highest balance that you have to report on the Schedule M. I would say the other one that's important is your Schedule J. I think you mentioned that at the get-go.
Yeah.
Where's your EMP?
And if you notice, Schedule J is for category 4 and 5 filers, so likely there may be some subpart F. There are no exceptions with those categories.
Yeah, your H are your EMP adjustments. Your I are basically your potential subpart F and 956 loan area. O, if you're liquidating, merging, reorganizing, or selling, it should be reported on the L.
So, and I don't know if everyone remembers, but in the beginning we talked about the Section 965, and you get the accumulated EMP. if you notice Schedule J, it should be a good comparison when you're done with your EMP workbook of calculating from the beginning when it was the foreign corp was this specified foreign corp. So that's a good indicator. It should be similar. Just wanted to point that out.
I would run through the PFIC stuff, so
Yeah.
we could get 5 minutes on guilty.
Yeah,
and
so
say,
you know we'll skip through that then. Yeah. So we wanted to at least touch up on guilty. As we mentioned in the changes to the subpart F, 951A creates a new category of subpart F. It assumes that CFC's normal return on its tangible assets is 10%, and this is what we're talking about with even though it's guilty and tangible, it's really based on your tangible assets, right? So the participation exemption applies to the amount. Profits in excess of the return on the tangible assets will be treated as income from intangibles, and this is guilty. So that's high level. I don't know if that's going to touch.
No, go ahead.
Domestic C corporations can take a deduction for 50% of their guilty inclusions, and foreign tax credit is partially allowed 80% on the guilty inclusions. And this guilty, this part of subpart F is done every year. So as you can see with corporations, it's favorable as they could be paying at a rate of 10.5% versus an individual who would be paying the, 37% tax rate. I know there's different, you can make the section 962 election and they could possibly pay at the 21% rate, but it's unclear if they would get the favorable 50% deduction that C corporations get. So that's still in the air, and we're waiting for regs and more guidance on that to come out. So as you can see, guilty is pretty bad for individuals, partners pass-throughs. So a lot of planning is done in this, but at the end of the day, no move. I don't want to say any decisions have been made because there's no definitive guidance on how certain parts of the guilty.
So just stepping back, is everybody aware here why Malaysia would not potentially get a qualified dividend? Any distributions from Malaysia would not be classified or characterized as qualified dividend. The assumption, so in order to get qualified dividend treatment, you need to have a distribution from a treaty country. So if the U.S. doesn't have a treaty with that jurisdiction, then in that instance you don't get qualified dividends. It's not qualified dividend, so you don't benefit from the lower withholding tax rate of 20%. The other thing here that's very important to note, there's a little bit of uncertainty when it comes to an individual making 962 election if he gets the benefit of the 50% deduction. But the one I really wanted to touch upon was the FTC. It's very important to note that even when you're doing the foreign tax credit basket, you have a guilty basket now. That's one thing. The other thing it's important to note that you don't get 100% of the foreign tax credit, right? Whether it's 960 or it's 960 in this instance, you don't get 100% of it. The only thing that gets you 100% foreign tax, 100% of the taxes you paid locally, and it qualifies as 960 foreign tax credit, is if you have subpart F. So for years prior to, let's say 1/1/2018, we were busy planning around subpart F, the provisions there. Now, in order to basically the foreign tax credit, let's say in certain jurisdictions with high taxes, now we're planning into subpart F in order to potentially generate the subpart F, but it gets to be foreign tax, 100% of the foreign tax credit. So assume, for instance, now I'm taxing the U.S. at 21%. So I have earnings and profits in let's say the UK. The reason I say the UK because the UK is a favorable jurisdiction under the local law. There's 0% withholding tax on dividend distributions. So it's important that any distributions coming from there on the local law are not taxed. So I don't have to worry about participation exemption being an issue. But now what I have is I have this guilty thing I have to be concerned myself. So, it really comes down to a number crunching exercise. And you look at what would be my guilty liability exposure, and then, I offset that guilty exposure, tax liability, with 80% of the foreign tax credits I have below in the UK. Whereas if I somehow come up to generate subpart F income, right, then I'm now getting a tax credit of 100% on that, 100% of the local taxes. UK pays 17%, so I'm looking at 17% against 21 on the one example. In guilty, okay, I'm getting 80%, but what I'm also taxing is, what, 10.5, right?
Yep.
So a different rate. And it's a really number crunching exercise you have to go through.
So I guess we'll end with these last few slides. 4 principal ways to deal with the guilty, but of course it's not limited to this. You pay the guilty tax, right? Make a 962 election to be taxed as a corp, so you're paying it, if you're an individual, you're paying at 21% versus your 37%. Transfer existing entities to a US C corp. Decontrol to avoid the guilty tax, which is the most drastic one. And there's another one that's not on here, but another one would be check the box on your CFCs. But like I said, it's all about fact pattern, cost benefits, and what works.
But even checking the box after you've had an existence and you incurred a guilty tax, or you would be subject to guilty, would generate a guilty tax. So you have on the gain.
Yeah. And paying the guilty tax, we talked about with the rates, and I think that's all we have for today. So thank you guys.
Thank you very much. Any questions? Sorry. My friend here is anxious to get out. Beat the traffic.
Traffic? Does anyone know when the Blue Book